Welcome to this comprehensive course on deferred rent under ASC 842. Deferred rent is a critical concept in lease accounting, and the transition from ASC 840 to ASC 842 has introduced significant changes in how it is handled. In this course, we will break down the concepts, compare ASC 840 and ASC 842, and review the journal entries required for compliance. By the end of this course, you will have a solid understanding of the nuances and practical applications of deferred rent accounting. Let's get started. Under ASC 840, deferred rent arose due to uneven lease payment schedules, such as leases with escalated rent payments over time. The standard required straight-line expense recognition, meaning the total lease expense was evenly allocated over the lease term, regardless of the payment schedule. The difference between the cash paid and the straight-line expense was recorded as a deferred rent liability or asset, depending on whether payments were higher or lower than the recognized expense. This approach aimed to smooth out the expense over the lease term. Let's look at an example to solidify this concept. Imagine a lease with payments of $10,000 in year 1, $12,000 in year 2, and $14,000 in year 3. Under ASC 840, you calculate the straight-line rent expense by averaging the payments over the lease term. In this case, the straight-line expense is $12,000 per year. In year 1, the cash payment of $10,000 is less than the expense, creating a deferred rent liability of $2,000. The journal entry reflects this liability, ensuring the expense aligns with the straight-line requirement. ASC 842 introduces a significant shift in lease accounting. The focus is now on recognizing lease liabilities and right-of-use (ROU) assets on the balance sheet. This approach enhances transparency by requiring organizations to account for leases in a manner that reflects their true financial obligations. Deferred rent adjustments are no longer treated as standalone liabilities, but are incorporated into lease liabilities. This change streamlines lease accounting while ensuring compliance with the new standard. To illustrate how deferred rent is handled under ASC 842, let's revisit the example. The lease liability is initially calculated using the present value of future lease payments, and an ROU asset is recognized. Differences between the lease expense and cash payments adjust the lease liability. In year 1, for example, the lease expense is $12,000, cash paid is $10,000, and the remaining $2,000 is added to the lease liability. This approach ensures the liability reflects the total unpaid lease obligation. For leases that existed before the adoption of ASC 842, transition adjustments are necessary. Deferred rent balances under ASC 840 are reclassified into the ROU asset. This reclassification aligns the accounting treatment with ASC 842's requirements, ensuring that all lease-related balances are properly presented on the balance sheet. This step is critical for ensuring a seamless transition to the new standard. Here's a detailed example of a transition journal entry. Assume a deferred rent liability of $6,000 exists under ASC 840 at the time of transition. Under ASC 842, this liability is reclassified into the ROU asset. The journal entry removes the deferred rent liability and increases the ROU asset by the same amount. This adjustment ensures the balance sheet accurately reflects the lease's financial impact under the new standard. The treatment of deferred rent under ASC 842 represents a significant departure from ASC 840. Under the old standard, deferred rent was recorded as a separate liability, while ASC 842 incorporates it into the lease liability. This change simplifies the presentation of lease-related balances and aligns with the broader goal of enhancing transparency in financial reporting. Understanding these differences is key to ensuring compliance and accurate reporting. Let's take a comprehensive example. Consider a lease with payments starting at $10,000 per year and increasing by $2,000 annually over 3 years. Under ASC 840, deferred rent accumulates as a liability due to straight-line expense recognition. At the time of transition to ASC 842, the accumulated deferred rent is rolled into the ROU asset. The lease liability and ROU asset are then recalculated based on the remaining payments, ensuring alignment with the new standard. In summary, we have explored the changes in deferred rent accounting from ASC 840 to ASC 842. We reviewed how deferred rent was treated under ASC 840, the adjustments required for compliance with ASC 842, and the process for transitioning existing leases. These changes enhance the transparency and accuracy of financial reporting, ensuring lease obligations are properly reflected on the balance sheet. Thank you for attending this course. Deferred rent accounting can be complex, but understanding the principles and practical applications is critical for accurate financial reporting. If you have any questions, feel free to ask. For further learning, I encourage you to review your organization's lease agreements and apply these concepts. Thank you, and best of luck in implementing ASC 842 in your accounting practices. iLease Pro is your go-to solution for managing lease accounting under ASC 842. With features like automatic straight-line expense calculation and real-time deferred rent tracking, our platform ensures your organization remains compliant while streamlining your accounting processes. Whether you're transitioning from ASC 840 or starting fresh, iLease Pro makes lease management easy. Visit iLeasePro.com to learn more about how we can support your lease accounting needs.